Welcome to The Explainer. Today, we're digging into KeyCorp's latest earnings report. So we're going to unpack the big numbers, uncover the strategy that's really driving them, and see what it all means for the bank's future.
All right, let's just jump right in. The headline number that immediately grabs you is this: a 17% jump in year-over-year adjusted revenue. I mean, that's a powerful start, and it tells us there's a really compelling story to uncover this quarter.
And you know that impressive revenue growth? It went straight down to the bottom line. The bank posted a net income of $454 million for the quarter. And this is so crucial because it shows that growth isn't just for show, it's translating into real, tangible profit.
So what's actually behind these huge numbers? I mean, a 17% revenue jump and nearly $500 million in profit, that doesn't just happen by accident. So let's unpack the key highlights that paint a picture of a very positive and, more importantly, a very deliberate quarter.
You know, what's so striking here is the all-around strength. It's not just one metric looking good. They are firing on all cylinders. You've got a solid net interest margin at 2.75%. That's basically the bank's profit margin on its loans. But really pay attention to assets under management, up 11% to a record $68 billion. That tells you that wealthy clients and institutions are trusting KeyCorp with their money, which is a powerful vote of confidence.
But growth is only half the story, right? A bank's health also depends on really strong fundamentals, especially credit quality. And Key's metrics here are just solid. For instance, net charge-offs, that's the debt the bank figures it won't collect, stayed low. This shows they aren't just taking on a bunch of crazy risks to get that growth. It's a smart, stable approach.
Okay, so let's see how this all builds. Where exactly is this growth coming from? It's time to look under the hood at the specific engines that are driving all this performance. A huge piece of the puzzle is their fee-based income. This stuff provides a steady revenue stream no matter what interest rates are doing. And investment banking was the absolute star of the show, bringing in $184 million. Actually, it was their second best performance ever for this time of year. That really highlights a serious strength in their corporate and investment banking divisions. Now this slide brilliantly illustrates a very clear strategy. Just look at the difference here. The bank is actively growing its commercial loan portfolio by over 4%. And at the same time, it's intentionally letting lower-yield consumer loans just run off the books, down almost 8%. This is no accident. It's a calculated decision to focus on more profitable, relationship-based commercial lending. They're optimizing their balance sheet for higher returns.
And here's the crucial part. This growth isn't coming at the expense of safety. It's all built on an incredibly solid foundation. Just look at these capital ratios. The Common Equity Tier 1 ratio, or CET1, is at 11.8%. All these figures are way above the regulatory minimums, putting the bank in the well-capitalized category. Let's quickly break down what that CET1 number actually means. So for those who might not be familiar, the CET1 ratio is one of the most important things regulators and investors look at to gauge a bank's health. Think of it like a stress test score. It shows how well the bank can handle unexpected losses. A higher number means a stronger buffer, and well, Key's is looking very, very healthy.
So this strategic focus on commercial lending, it creates two really different stories when we look at KeyCorp's main business segments. It's almost like looking at two different banks operating under one roof. The commercial bank is the clear powerhouse here. It generated $367 million in net income. That's more than double the consumer bank. This really drives home where the company's profitability is concentrated.
This table adds another fascinating layer. Now, while revenue growth was pretty similar in both segments, look at that net income line for the consumer bank. It more than doubled. What's so amazing is that they did this while intentionally shrinking their loan book. That points to a massive improvement in efficiency. Meanwhile, the commercial bank just keeps chugging along as a powerful engine, driven by that steady loan growth.
So after a quarter like this, you've got strong growth, a clear strategy, solid fundamentals. What does the road ahead even look like for KeyCorp? Well, let's just say they are not planning on slowing down. The company's leadership is using this strong quarter to set a really high bar for the future. The CEO is targeting a 15% or better return on tangible common equity. Now, in simple terms, that's a key measure of profitability that shows how efficiently they're using shareholder money. Hitting 15% would be a very impressive achievement.
And here's a look at how their current results stack up against those ambitious medium-term goals. They're at a 12.5% return on tangible common equity now, with a clear path to that 15% plus target. Same story with the net interest margin. They're at 2.75% and are aiming for over 3%. They've laid out the destination, and this quarter's results show they are definitely on their way.
So, how are they going to get there? Well, the strategy is refreshingly straightforward, and it really just builds on what's already working. First, keep optimizing the balance sheet. More of those profitable commercial loans, less of the lower-yield consumer debt. Second, double down on the high-performing fee businesses like investment banking. And third, keep a tight grip on costs. It's a simple but really powerful formula.
And this brings us to the big question, doesn't it? KeyCorp has a crystal-clear strategy and a quarter of really strong execution behind it. But can they keep this momentum going in a changing economic landscape? Will this intense focus be enough to hit those ambitious targets and deliver the outsized growth they're promising? We will definitely be watching closely.